This will just be a brief introduction to different types of pensions. There are defined contribution plans and defined benefit plans. So what are they? Well, why do employers offer pensions? It's thought to reduce employee turnover if they are getting this type of benefit, employee benefit. It's thought to enhance productivity. It satisfies union demands. And it can allow employers to compete in labor markets, because if you might not be completely happy with your job, but if looking long term, if you have a good pension, you're going to stay there until you retire if it looks like a strong pension to help you in your retirement. So what is a defined contribution plan? That is a typical 401k. The not-for-profit businesses use 403bs, but it's really virtually the same. You may hear the term saving plans or thrift plans, employee contributions, employer matches. You may be contributing and your employer may agree to match some of your contribution as part of the benefit. A defined benefit plan, that is different. That is a traditional pension. It's a fixed retirement amount, and it's determined by a formula. So actually, your contributions to the pension plan, to a defined pension plan, and what you eventually get in retirement, you could end up getting more than what is in there because of the traditional pension plan structure. So pension plans and the sponsoring company of the pension are two separate legal entities. And this is an important concept because the actual pension, the entire amount, will not be on your company's balance sheet. Separate financial institution manages the pension, and that's because you don't want your company managing it. And what if you get an unethical CFO or CEO who kind of skims from the pension plans because it's under their control? This is why it should be separate. It needs to be managed by a separate bank or financial institution handling the pension separate from the company's control. So the company must account for periodic pension expense regardless of which type it is. And they must make periodic contributions to the fund the pension account held separately. This could be from the employee payroll withholding amounts, or the company can contribute with the defined contribution plan. The company only shows a net difference on their financial statements. That's an important concept. So there will be the liability of the pension and the funded amount. How much money has been sent to that financial institution, to that bank, to that investment company to manage your pension? The net difference, that's the only thing that will show up on the balance sheet, not the total amounts. The actual total funded amount of the pension plan is in disclosure notes from the financial statements of that separate financial institution. Often the disclosures as according to GAAP rules, they're not really adequate, and FASB and ISB are looking at maybe changing some rules down the road, but right now this is the way the rules stand. For companies, there will be the income statement accounting issues and the balance sheet reporting issues. The immediate earnings effect, there will be some of this for the defined benefit plans that will affect the income statement, and some will affect the balance sheet because there is some income smoothing through accumulated other comprehensive income. So a defined benefit plan, the traditional pension. This is a promise from the employer to pay a fixed retirement amount, and that benefit, the amount that you get, it's determined by a formula. The employer will choose how to invest the funds, so the employer has the burden of managing it through that separate financial institution, and the tax benefits go to the employer, not the employee, for a defined benefit plan for immediately. The formula is based on often years of service, annual compensation, your age, and it's going to depend on the employer's investment in success. Now, typically this represents less than 1/3 of all retirements. This is probably a little old data. It could even be 1/4 of all retirements. Many companies are converting to defined contribution plans. just because of the risk involved with offering a defined benefit plan. Although it's great to have a defined benefit plan, there's a tremendous amount of risk for the employers to maintain the funded amount in economic downturns. And the funded amounts to cover future pensions are invested with the hope of a continued strong growth over time. But still, the burden is on the employer, not the employee. Now, this is very complicated accounting, so we're just giving you an introduction here. Defined contribution plan. This is more popular these days with companies. It moves the responsibility for funding the retirement funds from the employer to the employee. The employee must contribute the bulk, even though there could be an employer match, but that match can change from year to year. In bad economic times, many boards of directors will say, well, we can't contribute this year. We've got to wait for the economy to turn around and our profitability to turn around, and then we'll consider matching again. Retirement pay depends on the size of the fund. It's not a formula. So once you have withdrawn, when you're in retirement and you've withdrawn your entire 401k, it's gone. But with a defined benefit plan, it's not based on that. It's a much larger fund, and you're guaranteed for the rest of your life based on that formula, how much you're going to get. So back to the defined contribution plan, the typical 401k. The employee is the one who decides how to invest, not the employer. Periodic fixed contributions usually allowed to be changed on an annual basis. And the tax benefits, instead of to the employer with a 401k, it's to the employee. You get to put this in pre-tax. Now, this is from an old textbook, so right now I would estimate it's probably 75% of all plans in our country are now defined contribution plans. This would be your journal entry for the company, but then that's all they have to do. Pension expense and cash, and they can only expense what they contributed. If there is a match, if it comes out of the employee's pay only and there is no match, then the company can't record an expense. They simply remove the liability and transfer it. All risk of future value, once the money is with that separate financial institution, is transferred to the employee. Now, the reason for the shift from defined benefit plans to defined contribution plans, government regulations have increased administrative costs, and many employers are not willing to take on that risk. And we saw that risk come to light during the recent financial crisis of 2008 and 2009. Long-term loyalty of employees is not thought to be as important. We're more of a mobile society. Typically now employees hold many jobs over their lives, as opposed to 30 and 40 years ago where you had one job for life and then you retired. Recent laws make DCP rollover plans much easier also. So when you change jobs, you can simply roll over your 401k. So looking at income tax benefits, we're going to look at a comparison here. Let me go back to that. For defined contribution plans, the employee gets the benefit. For traditional, the employer gets the tax benefit. 401ks, they're not taxed at the time of contribution, taxed on future withdrawals later. And there are IRS rules for that. You might see the 10% penalty if you remove it, if you withdraw anything without any exemptions before you're 59 and a half. But sometimes it's worth it. You can use that 401k as your down payment for a house. That's one of the current exemptions for the IRS. On the defined benefit plans, the employer gets an immediate tax deduction for how much they paid in. For contribution plans, the employer may match. It will depend on the company performance. You might hear terms profit sharing, incentive savings plan. Employee contributions, of course, have the bulk of it. For the accounting purposes, you record pension expense for cash contributed to the employee's pension plan, but that's just the match. Otherwise, it's just withholding from the employee pay, put in a temporary liability account, and then that's transferred to the financial institution. Record keeping is handled by the bank. The employer is only responsible for the initial contribution and sending it to the bank. Once that's done, that's handled. Their responsibility is done. For traditional pensions, defined benefit plans, there are many risks and uncertainties: rate of return, age and life expectancy, turnover rates, longevity, inflation, future compensation, because the actuary will be estimating future compensation, and there are many unknowns, so this makes it difficult. And it's not the accountant's job. You need an actuary who is an expert in statistical calculations to come up with that pension formula. So the key elements are the employer's obligation, the periodic pension expense, and the funding of the plan assets. These are the three key areas that we will cover, and there will be separate videos for these. Pension plan obligations, you'll hear the term ABO, VBO, and PBO. These are the definitions. But it's all just three different ways to calculate the same employer liability. What goes into it? Many components. Service cost, prior service cost, interest cost. Pension plan expense, what goes into calculating this, gets complicated because part of this is expensed immediately and part of it is amortized and gone through other comprehensive income. So it'll sit on your balance sheet. That's one of the four components of accumulated other comprehensive income. And for this, you want to use the greater than rule. That'll be talked about in a different video. It's the 10% rule. For pension plan assets, that's what the separate financial institution is holding, but the company has to send it there. And cash contributions and return investment growth on those in the plan assets, the investments, interest and dividends, and capital gains, that all will increase the plan. And of course, paid out will decrease the plan. The funded status. This is, remember what was mentioned earlier, this is the only thing shown on the company's balance sheet. The net difference between the obligation and the plan assets. If it's undervalued, if the PBO is greater than the plan assets, you record it as a liability on the balance sheet. If the plan assets are greater, you record it as an asset. But again, you do not record the entire thing. You record only the net difference. Accounting issues that must be addressed: pension expense, net assets versus liabilities, and do understand the total PBO. That is in your disclosure notes only. That will never show up on the balance sheet. The plan assets will not either.